Now joining us, Deven Choksey, Managing Director at DRChoksey Finserv. Deven, hi. We are in the fag end of the earnings cycle. If you look at the Nifty 100, 98 odd stocks have come out with earning and decent earnings where profitability has jumped nearly 13 to 14% on a YOY basis. How do you look at the entire earnings?
Yes, Sahil. Good morning. I think the overall earning season has remained pretty satisfactory. And more satisfactory is the kind of outlook that most of the companies have talked about, even in the earning call commentary. Even though I think these 2 months, April and May, both these months of the new financial year, are troubled months in a way because of on one side the logistic related challenges are there. The cost because of those logistic related challenges have gone up as far as inputs concerned, and the fuel prices have also remained at an elevated level. So obviously, I think everything is affecting negatively on the profitability side. Yet the companies are coming up with the guidance where they are talking about steady to higher execution of the business setting which they are undertaken, particularly in the area of the manufacturing space where infrastructure space is connected, power and power utility is connected. Most of the companies have shown the resilience and they are showing, I think, promises on higher side. So we like to believe that yes, there will be some profit margin pressure in the coming quarter, but overall, the business likely to remain, I think, steady to higher side. And should the war-related outcome turns out favorable, then possibly I think the markets will have a more cheer to talk about, and I think would look up. I would typically think that this is the time, the first half of the current financial year, should be the time in which I think you should gradually be accumulating some of the good quality stocks, I think, which have come up with earnings as well as things showing better promises.
Deven, at least today, the kind of tilt that we're seeing, some of the shoe wear or shoemaker companies have delivered some very strong numbers. Relaxo also came out with numbers. Bata's numbers were slightly softer, but outside of that, stocks like Campus, stocks like Metro Brands, they've done very well. Is that a possible tactical buy at this point, just given the kind of numbers that they've clocked, or stocks have run up?
So, yeah, I do not know, I think, whether they are tactical buys at this point of time. I think, and given the situation in which I think the input costs are rising, I do not know, I think, whether everyone is, I think, safe in this kind of environment, particularly the price sensitive businesses. So do not think immediately that I think one should be looking into it unless I think the valuations are compelling in some of the stocks. As of now, since we don't have coverage, I wouldn't be able to give any specific about the company, but I feel that I think the fairly bright stocks they are at this point of time.
Relaxo trades at 40 times, so at least that's the perspective. Anything, Deven, that stood out for you in this earnings season?
Yes, I think few companies where we track and we believe that I think have given a very strong start to the current financial year as well, apart from reporting the numbers last quarter. One among them would be Tata Technology. Came up with a very strong set of numbers and equally strong set of guidance. And probably in last 8 or 9 quarters, whatever the cost-related pressure that they had to absorb, they have completely absorbed. And now the new JV with BMW is also roaring to contributing to the business. So frankly, I think we find that companies like Tata Tech, who are inherently strong because of the two segment focus in transportation. One is automobile and second is aviation. In both these segments, the kind of services that they provide along with the embedded software, I believe that I think they have miles to go, probably I think much better output that we can talk about in this country. Similarly, companies like Bajaj Housing Finance, though 14-15% reported growth, but still a little bit conservative on the side of lending. At the same time, compared to industry growth of single digit, I think they are double digit on 150,000 crore AUM book size. We like this company from investment, long-term investment perspective as well. So yeah, some of these companies they are standing out and promising to do better.
Okay, let me go across to Karan. He's standing by with the takeaways from Mphasis' management meet. They spoke about how they're using AI to transform their own business and what they're doing in terms of managing this transformation. Karan here with all of the details.
Well, yes, let's take a look at some of the key takeaways from the analyst meet, wherein the EBITDA margin guidance has been maintained in the range of 14.75 to 15.75%. Moreover, the subscription revenue mix is currently in low single digits, and the target is 20 to 30% in the medium term. Moreover, the pipeline has grown 4 times in the last 18 months, and the large deal mix has improved to nearly 30% in FY26. The average deal size has also increased to $75 million from $54 million, and the company is aggressively targeting vendor consolidation deals to increase its wallet share at blue chip clients. Moreover, the delivery model is shifting from the functional silos to AI-led cross-functional pods. The talent pyramid is moving to a diamond model where AI handles repetitive work. On that note, the management sees brownfield AI integration as a bigger opportunity than greenfield AI. Management has also highlighted 95% of the AI pilots fail to scale due to legacy integration challenges. On that note, the management has said that the margins could have been 200 basis points higher without these investments, and despite the investments, the operating margin guidance has been maintained in the range of 14.75 to 15.75%. Over to you.
Okay. Deven, how do you expect some of these IT companies to manage? And of course, we'll have that interview with regard to Mphasis. We'll speak with management. It's a 10 a.m. Chat which has been slotted. But Deven, what's your take with regard to some of these IT companies and them managing this entire AI risk?
So, in my viewpoint, I think having understood the subject from most of the companies and believing that I think the AI is becoming, I think, a new opportunity for most of these companies. On one side, currently the world is basically investing into building the AI-related infrastructure, be it, I think, data center, or be it, I think, LLMs or SLMs. We believe that, I think, on the other side, the service providers like Indian IT companies, be it embedded service providers in the mid-tier IT space, or be it, I think, some of the larger companies who are providing the complete support and service to their customers, I find that AI has become enabler for them. They have significantly cut down on one side, I think, their time to provide the solution to the customer. And on the other side, I think started saving the costs because I think the coding and other stuff, I think, is now AI enabled. So to a greater extent, the profitability quotient is increasing because of this particular shift which has happened. And we believe that I think this is just the beginning because I think some of the large corporates would probably, I think, be having a larger need to transform themselves through the use of AI, as can be witnessed from the data center related activity. So with Indian IT service companies who are the service providers could possibly see the larger intakes in form of orders, etc. So we remain selectively bullish and optimistic about, I think, the prospects going forward for select companies in the portfolios.
Do you think that now the street may be now not looking at the revenue guidance, but more on EBITDA growth and EBITDA margins for IT companies?
Absolutely, because I think the most of these companies are saving on one side. The front-ended cost, I think, is significantly saved, if I were to say, including the coding cost. And on the other side, I think the billings are changing from time and effort basis to outcome-based billing, as could be experienced also from some of the mid-tier IT companies and some of the larger ones as well through the new contract that enter into. So we are distinctly confident that the entire shift is happening, the transition is happening on even the billing side. And that's where we second this particular thought that yes, margins and other things are eventually looking up and not coming down. So remain confident on that particular possibility.
Okay, we'll take a pause on the conversation. Plenty to speak about though. Lots of earnings which have trickled through. Some stocks in focus on the back of MSCI rejig. Some stocks on the back of some block deals which are expected to play out. We'll talk about that and more on the other side. Stay with us.
Give us a sense of how you're looking at some of the retail plays. V2 Retail came out with very good set of numbers, but at the same time you had Bata, which was struggling to get price growth, or the growth of revenue growth of 5% was mainly volume led, and there's EBITDA impact also which is there.
My understanding about Bata, I think they are possibly losing out on, I think, the kind of penetration that is required as far as I think the market demand is concerned. So I think that's where this particular company is struggling and struggling for a good time now. So, in spite of having very strong distribution reach, I think they still have the follow-up appeal, I think, from the consumers. Other retail segment players, including the quick commerce companies, I think they remain relatively more favorable. They are clocking larger volume. Does indicate that a higher amount of wallet share is being attracted by them. And that's where we feel that I think they are relatively safer or better placed. However, if you ask me from investment perspective, I think the valuation wise everything is in price today. So not seeing major upside unless the market gives a sharper correction, I think would probably not immediately jump into those companies.
Okay. Deven, also curious to know what's the take with regard to some of the power ancillaries? Are those still companies which would look interesting given the kind of surge in power demand and the like? Is that a theme at all that if someone has not participated in, is it a good time to kind of get in?
Yeah, the beautiful opportunity, frankly. If you ask me, next 5 years seems to be the years of power utility, power ancillary companies, including capital goods companies who are providing a solution. So I think on one side, generation companies, of course, but on the other side, more importantly, engineering companies, transmission and distribution companies, and finally, I think the power finance companies. So if you look at the entire portfolio, we believe that I think the higher amount of traction and growth could be seen in the mid-tier, that is in the engineering segment and the transmission segment. Engineering segment in particular, they are basically having the opportunity in form of the various sources of power today. I think apart from the thermal, hydro, conventional sources, you have got now the solar, the wind, the biogas. Soon, I think you would be having hydrogen as well as the nuclear energy. Now, each of these areas where the power gets produced, I think finally it is getting evacuated and transmitted. And that's where some of these companies will have major role, likes of Hitachi Energy, Siemens Energy, or Siemens ABB for that matter. I think those kind of companies from the investment perspective. Though fully agree that I think today price, I think is already reflecting the current years of execution. But if you are looking at 28, 29, probably I think you are getting slight advantage and maybe some correction in the stock price definitely gives you bigger advantage to buy on a structural long-term output basis.
And the other one, Deven, is PB Fintech. That one will be in focus today because you have 0.8% equity, which the promoters will be selling. In fact, they've already sold. I could see that that news trickle through that there's been a block deal. So it's happened pre-open itself, which is positive news, frankly, from a stock perspective. Deven, some of these platform companies, Eternal was one of the strongest in terms of clocking growth, understandably so, but now focusing on profitability. You've also got PB Fintech in focus today. What's the take?
Well, I guess I think I'm a believer of the tech companies and probably the business model therein. So there is one important aspect that I think the business outlook continues to remain very attractive for them as far as I think the opportunity goes in building the top line. Companies are spending huge amount of money on building the top line, and sooner you realize, I think they've been spending more on the technology front as well, in a very systematically upgraded manner. But given the fact that, yes, I think they've started coming into the profit picture, but given the fact that their challenge remains, I think, with the current market capitalization. Most of the companies, I think, on a current profit base, and even if it is compounding at a higher rate of growth, I still feel that I think everything is in price. So I don't know whether I think one would jump into it even though they look convincing on the top line basis.
Another section of stocks is the Adani Group stocks, which have been rallying for the last 2 weeks. Do you have a view on some of the infra plays in Adani Group and the power plays?
In fact, I think you should remain structurally bullish on this particular entire space, because most of the infrastructure units, I think, which they have, be it road infrastructure, airport infrastructure, now the data center infrastructure, which is coming up, or even in the power and power utility segment, where they have got the conventional power to green power to transmission business. Each of these businesses are cash generating business, and probably I think that is most important. The annuity nature of revenue generation in some of these cases is certainly giving a good scope for buying this company in the portfolio, because we have got not only 1 to 3 years of visibility, but I think next 15 to 25 years of visibility from these companies. Yes, agreed that I think they have moved up very sharply in last 3-4 weeks, and so because of the positive news. But whenever I think the market gives an opportunity at lower levels, I think they remain favorites as far as India infrastructure and the growth story is concerned within that.
Okay, Deven, thank you so much for joining us this morning. We'll let you go on that note.
Thank you so much.